Welcome, curious minds, to another deep dive. Today we're unpacking a really fascinating financial paradox. When you think of best-paying jobs, right? Doctors, they consistently top those lists. Highly educated, highly skilled, often earning, significant incomes. And yet, when we look beneath the surface, a surprising number of them are actually wrestling with financial struggles. Drowning in debt, worried about their future. It just seems counterintuitive, doesn't it?
It absolutely does, yeah. What's truly intriguing here is that despite their, immense earning potential, many physicians encounter a unique set of financial challenges, and these can be incredibly complex to navigate without some very specific knowledge and strategies.
That's precisely what we're here to explore. Our mission for this deep dive is to pull back the curtain on that distinct financial landscape for physicians. We've meticulously reviewed a whole stack of sources covering critical considerations for doctors, things like taxes, retirement, asset protection, and of course, debt management. Our goal: to extract the most impactful insights, arming you with strategies to understand why these challenges exist and how these high-income professionals can genuinely secure their financial well-being.
Exactly. In this deep dive, you can expect us to explore the surprising underlying reasons behind physician debt. We'll uncover some very common yet often overlooked asset protection pitfalls. We'll try to demystify those daunting student loan payoff strategies and then navigate the intricacies of retirement and tax planning, especially, in light of recent tax law changes like the TCJA.
And here's the crucial part. This isn't just for doctors. If you're navigating high income, maybe grappling with significant debt, or simply curious about complex financial decisions, you're going to uncover some major aha moments. These are broadly applicable insights. Okay, let's unpack this financial enigma, starting with what we're calling the high-income debt dilemma.
Indeed, it's a striking contrast. For instance, U.S. News and World Report's 2019 best-paying jobs list. Well, the top 11 spots were all medical professions. Yet our sources reveal that many doctors carry substantial debt, often throughout their careers. Take 2018 data. A staggering 76% of medical students graduated with debt. And the median figure, it stood at $192,000.
Wow, and the numbers can get even higher, right? I saw some of the private schools.
That's right. We're talking 21% of private medical school graduates carrying $300,000 or more in debt. When you consider the average cost for a 4-year program is nearly $243,000.
Okay.
And private schools can hit over $322,000. Well, you begin to grasp the sheer scale of that initial burden.
So the big question is why? Why are doctors, even with these impressive incomes, finding themselves overspending or just taking way too long to pay off these loans?
It often boils down to a few core factors, it seems. First, there's a strong societal expectation. Doctors can feel an unspoken pressure to spend like a doctor, to live up to an image of wealth. This can lead to really rapid lifestyle inflation, pretty much the moment that higher salary hits.
The finally I've made it spending spree. Yeah, I can certainly see how that temptation would be powerful after years and years of intense training.
Exactly. And secondly, after a decade or more of grueling education and training, there's this profound sense of delayed gratification. They've put their lives on hold, really. And now there's an urge to immediately start living a normal life, which often translates into significant purchases, house, car before the debt is really under control.
So beyond the psychological stuff and the social pressures, is there a more fundamental reason, maybe like educational? Why do so many highly paid doctors struggle financially?
Absolutely. The third and perhaps most critical factor is a surprising lack of formal financial training. Many doctors simply haven't been equipped with robust personal financial management skills. They excel in medicine, obviously, but often lack the habits of, say, wise saving or strategic investment, and those are crucial for managing significant income and debt.
Right.
This highlights a crucial point for all of us, really. Financial literacy isn't just for those struggling with limited income. It's vital for everyone, regardless of income level. Because high earners face unique psychological and practical challenges, like managing that lifestyle creep, that can derail their financial plans just as easily as anyone else's.
That's a really profound takeaway for all of us. Okay, now let's dive into that massive elephant in the room for many doctors: student loans. The challenge is just immense. Traditional repayment can drag on for 10, 20, even 30 years. But our sources lay out some powerful strategies to conquer this.
They do, and these are concrete, actionable steps. One of the most impactful is considering refinancing with a private lender. Federal student loan interest rates for graduate programs like med school were around 6.6% back in 2018-19. Reputable private lenders, however, have been known to offer rates significantly lower, sometimes as low as 1.95%.
Wow, that low.
Yeah, that difference over years can mean tens or even hundreds of thousands of dollars in savings.
That's a substantial financial advantage. What about those who might not have that immediate repayment capacity, say residents?
Right. For residents or those with lower initial incomes, federal income-driven repayment or IDR, plans can be a lifeline. These plans cap your monthly payments at a percentage of your discretionary income, which can make a huge difference in cash flow during those early lower earning years.
And taxes play a role here too, don't they? Into how those payments are calculated.
They certainly do. For married couples, the way they file their taxes, whether jointly or separately, can significantly impact their IDR loan payments. Plus, a skilled tax advisor can also help leverage deductions, like the student loan interest deduction, which back in 2019 allowed up to $2,500 to be deducted. Every bit helps.
Yeah. Now, I think a lot of people assume that with a high doctor salary, loan forgiveness programs are just totally out of reach. Is that actually true?
Not at all. Public Service Loan Forgiveness, or PSLF, can be a game changer. It offers student loan forgiveness after 10 years for physicians whose work qualifies as public service. So this means working for a government organization, a nonprofit, or certain other qualifying employers.
Okay.
It's definitely worth checking if your employer or practice falls under this category, as it can erase a significant portion of debt.
Here's something else that sounds like it could make a dramatic dent right from the start. Negotiating a physician's signing bonus. We're not talking about just a couple of grand here, are we?
Oh, far from it.
Uh-huh.
Our sources highlight that in 2017, the average physician signing bonus was $30,000.
$30,000 average.
Average. But the largest recorded was an incredible $200,000.
$200,000. Yep.
Imagine using that to pay down a substantial chunk of debt right out of the gate. That's a significant financial head start.
Absolutely. And finally, there's a strategy that requires, well, serious discipline, but it's a classic for a reason. Live like a resident for longer.
It's really about mental fortitude and prioritizing. Even with that higher attending salary, consciously choosing to maintain a more modest lifestyle for just a few more years, it allows you to aggressively attack your student loans.
Right.
And this isn't just for doctors, by the way. These are concrete, actionable steps that can be adapted for any significant debt you might be carrying.
Okay, from managing debt, let's pivot to safeguarding your future. For doctors, one of the biggest threats to their lifetime of earnings and assets is litigation. Our sources highlight that a startling 1 in 3 physicians faces a medical liability lawsuit during their career.
That's a daunting statistic.
Yeah. Data from the American Medical Association shows that nearly half, 49.2% of physicians over age 55 have been sued at least once. And the average defense cost alone, even if you win, was around $47,000 back in 2010.
Ouch. But here's a surprising reality, and this is important for perspective. Despite the fear, it's actually rare for physicians to lose everything, including their house in malpractice cases, especially if they have proper insurance.
That's a key point.
Our sources even cite Florida law, which protects individuals from losing their primary residence if they own their home outside of mortgages or rents anyway.
That's right. And the AMA also reports that a large majority, something like 65% of these lawsuits are dropped or dismissed.
Okay.
The legal costs can still average nearly $30,000 even in those dismissed cases. So it's not nothing.
Still expensive, yeah. Furthermore, 90% of cases are settled out of court, and 82% don't even go to trial, with insurers typically handling the settlements. So, if total financial ruin is rare, what commonly goes wrong? It often comes down to fundamental asset protection mistakes. And these apply to anyone building wealth, not just doctors.
Okay, so what are some of the most common asset protection mistakes that our sources identify? What should people look out for?
Well, one critical mistake is underestimating umbrella liability insurance. It's often an incredibly inexpensive primary layer protection that kicks in when other insurance limits, like auto or home, are exhausted.
So it's like extra backup.
Exactly. Another is maybe overestimating malpractice insurance. While it's crucial, it might not cover all scenarios or prevent financial strain if your practice assets aren't also protected. You need to look at the whole picture.
Okay, so you need both, and they serve distinct purposes. Got it. What else?
Another frequent error is improper asset titling. This sounds technical, but it's important. For example, if you own multiple vehicles, titling each one specifically in the name of the primary driver can help limit liability if, say, your spouse causes an accident in their car. It doesn't automatically expose assets titled solely in your name.
Interesting.
And many people misunderstand trusts. a revocable living trust. Excellent for avoiding probate, yes. But it generally doesn't protect assets from creditors. For that kind of protection, you typically need an irrevocable trust, where you legally give up control of the assets to gain that protection.
That's a really crucial distinction many might miss. What about retirement plans? Are they safe from lawsuits?
Not all equally. That's a common mistake, assuming all retirement plans are protected. Federally qualified plans like 401ks and defined benefit plans generally are protected from creditors under federal law, ERISA. That's a huge benefit. But other assets, like maybe large brokerage accounts or certain types of IRAs, depending on state law, need specific attention. Oh, and neglecting practice assets. Sometimes doctors focus on personal protection, but forget the business itself is an asset.
Right, the practice itself could be at risk.
Exactly. And finally, perhaps the most overlooked asset protection strategy, not minimizing taxes properly. Paying too much to Uncle Sam is, well, money that's gone. Money that could have been strategically protected or invested.
So good tax planning is asset protection.
In a way, yes. A skilled tax advisor can often uncover significant tax savings, which frees up capital and reduces the pot potentially available to creditors. It's a form of asset protection in itself.
Beyond the purely financial implications, our sources also touch on the profound personal cost of these lawsuits. It's not just about the money.
It's vital to acknowledge that. Yeah. Even if a doctor wins a lawsuit, there's often a significant emotional toll. Doctors can experience depression, a profound lack of self-confidence, or just persistent fear when returning to work after going through a case. Imagine going through years of litigation, the stress, the public scrutiny. It's not just about dollars and cents. It deeply impacts their well-being and their ability to practice effectively.
Absolutely. So these insights offer a more holistic view of protection, right? Not just from lawsuits, but from common financial oversights. And really, they're applicable to anyone building wealth and needing to safeguard it. Okay, let's shift gears again to long-term financial security, strategic retirement, and estate planning. It sounds like doctors have a tough road here too, especially early in their careers.
They certainly do. Those first 10 years of practice are absolutely crucial for compound investment growth. I mean, that's where your money really starts working for you exponentially.
Right, the magic of compounding.
Exactly. But physicians are often burdened with, well, everything we've discussed. Huge student loan payments, the significant cost of establishing a practice, maybe large mortgages for that doctor house. As a result, many high-income doctors don't max out their retirement plans during this critical period, and they miss out on potentially massive growth down the line.
So what are some of the most critical strategies our sources highlight for doctors to ensure they're truly ready to retire someday?
It really boils down to understanding your magic number, what you need to live on, and taking a few proactive steps. These steps might seem basic, but they're often overlooked under the pressures of a demanding medical career. First, setting a realistic retirement goal is paramount, not just a vague number, but a researched one. Then you absolutely must track monthly spending. You need to know where your money is actually going. This forms the basis for everything else.
Those seem like universal truths, Finance 101, but I can imagine how easy it would be to skip them when you're just overwhelmed with work and debt.
Precisely. Other key steps include aggressively tackling debt. The sooner you erase it, the sooner that money can work for you. Rigorously reviewing the cost of running a practice if you own one. That impacts your personal bottom line. You also need to plan for family emergencies, building up that robust emergency fund. Can't stress that enough.
Yeah, the unexpected always happens.
Always. And finally, consistently focusing on those long-term benefits. Recognizing that early, consistent saving, even if it feels small initially, delivers really outsized returns over decades.
How do you even begin to figure out that magic number for retirement? It feels daunting.
Well, you start by determining how much you actually need to live comfortably now, which means diligently tracking your spending. There's no shortcut.
Okay, track spending first.
Then you factor in costs that may increase in retirement, things like travel, hobbies, definitely healthcare, but also factor in costs that may decrease. No more retirement contributions, maybe less commuting, potentially lower taxes depending on your income sources. And crucially, you must account for inflation. Adding, say, 3 to 4% annually to your projections makes a huge difference over 20 or 30 years.
That's a big one that people often forget or underestimate.
It's a deal breaker if you don't consider it properly. You'll run out of money. You also need to assess your risk tolerance, how comfortable you are with investment fluctuations. Younger investors can typically afford more risk. And finally, create a realistic plan based on all this. It's tempting to predict you'll need less than is practical. Maybe you'll just slash spending.
Yeah, easier said than done.
Exactly. You don't want to be in a position where you regret retiring because you can't afford the life you envisioned.
What about tax-savvy retirement options? It seems like there are different rules for different types of doctors, depending on their employer.
Absolutely. It varies. For doctors who are employees of a hospital or large group, maximizing contributions to workplace plans like 401ks or maybe 403bs is usually the first step. Get that employer match, if there is one.
Free money, right?
Pretty much. Self-employed doctors or those who do a lot of moonlighting with 1099 income have excellent options like SEP IRAs and one participant or solo 401k plans. These allow for much larger contributions sometimes. Larger physician practices might even establish defined benefit plans, like old school pensions, which can be very powerful for high earners nearing retirement.
Okay.
And for personal savings, any physician with earned income and their spouse can contribute to an individual retirement account, an IRA, either traditional or Roth, depending on income limits and tax strategy. Once all those tax-advantaged accounts are maxed out, then you can explore investing in inherently tax-efficient securities like index funds or municipal bonds within regular taxable brokerage accounts.
Let's talk about estate planning for a minute. Why is it so crucial for doctors specifically? More so than for others, maybe.
Well, it's truly a doctor's mandate, I'd say. They often have larger estates to protect, including potentially valuable medical practices. They need to think about minimizing estate or inheritance taxes, avoiding probate, that's the often lengthy and public court process of validating a will. And a critical factor unique to physicians is addressing potential malpractice liability even after death.
After death, how does that work?
If their malpractice coverage isn't sufficient to cover a claim that arose before they died, creditors could potentially go after the assets left in their estate. So proper planning is key.
Wow, okay. So beyond just writing a basic will, what are the key components of a robust estate plan for a doctor?
It involves carefully choosing beneficiaries who gets what, appointing individuals you trust to control assets if you become incapacitated or pass away like an executor or trustee, and critically, naming guardians for minor children. That's huge for parents. And a crucial point our sources emphasize, a will alone isn't always enough to avoid probate. Setting up a revocable living trust, even if you also have a detailed will, is often the best way to help your assets bypass that court process, saving time, money, and maintaining privacy.
And the Tax Cuts and Jobs Act, the TCJA, that impacted estate taxes too, didn't it?
Yes, significantly. At the beginning of 2018, the TCJA basically doubled the federal estate, gift, and generation skipping transfer tax exemptions. It went up to over $11 million per individual and double that for married couples.
That's a huge exemption.
It is, but here's the catch. This is a temporary provision. It's set to sunset, meaning expire on December 31st, 2025. After that, the exemptions are scheduled to revert to the much lower pre-TCJA levels, adjusted for inflation.
Ah, okay, so planning is still important.
Very. If an estate exceeds whatever the threshold is at the time of death, the federal estate tax can be as high as 40%. That's a massive bite. So our sources suggest strategies like making tax-free gifts during your lifetime or setting up certain types of irrevocable trusts to proactively reduce your taxable estate, especially if you anticipate exceeding those limits even after 2025.
For mid-career doctors, maybe 10, 20 years in practice, it sounds like this is a really pivotal time to get their financial house in order.
Absolutely. Our sources highlight this as a really strategic pivot point, kind of a get serious moment. Key tips for this stage include fixing any past financial mistakes, maybe consolidating debt, correcting investment errors. Making a concerted push to pay off your mortgage is often a big goal here, aiming to head into retirement debt-free.
That must feel good.
Huge psychological win. It's also crucial to keep expenses in check, maybe resist further lifestyle inflation. A common goal is putting at least 20% of your gross income towards retirement savings during these peak earning years.
20%. That's a solid target. Sounds like a lot to juggle, though.
It is, but it's essential for building that substantial nest egg. This is also the time to really squirrel away cash for college, ramping up 529 contributions if you haven't already. You should evaluate your current financial status regularly, like an annual checkup for your money. This helps you decide if maybe early retirement or working less or eliminating stressful on-call shifts is becoming feasible.
Making work optional eventually.
That's the dream for many, right? You need to solidify your retirement plan, ensuring it's realistic and on track, recalculate that magic number, and finally, regularly update your estate plan. Life changes, births, deaths, divorces, kids grow up. Your plan needs to reflect your current situation and goals.
Right. These strategies really reinforce the universal importance of early and consistent planning for long-term security, adapting as your life stages and income change. Okay, let's wrap up our deep dive by trying to master the tax landscape, specifically understanding the impact of the TCJA and different medical practice structures. What are some quick tax tips for medical practices, or maybe any business owner who also owns a home?
Okay, quick hits. For homeowners, remember the TCJA changed mortgage interest deductions. Only interest on the first $750,000 of mortgage debt is deductible for loans taken out after December 2017. That impacted a lot of high-earning professionals in high-cost areas.
Okay.
But there's a fascinating provision in the tax code, Section 280AG, sometimes called the Augusta Rule. It basically lets you rent out all or part of your home to your own business, tax-free for you personally, for up to 14 days a year.
Rent your home to your own practice.
Yep. For legitimate business purposes, like holding meetings, the practice gets a business tax deduction for the rent paid, and you receive that income tax-free. It's a neat strategy if done properly.
That is a powerful strategy many might not know about.
Well,
What about saving for children's education? Any tax angles there?
yes. For educational savings, 529 plans are often superior to custodial accounts like UTMAs or UGMAs. With 529s, the money grows tax-free at both federal and usually state levels. Contributions generally aren't deductible federally, but withdrawals for qualified educational expenses are tax-free. Some states also offer deductions for contributions, and TCJA allowed up to $10,000 per year from a 529 to be used for K-12 private school tuition, too.
Good to know. And charitable donations. Any specific strategies?
For married physicians or anyone facing high standard deductions, $24,000 for married filing jointly in 2019, higher now, bunching donations can be smart. Instead of giving, say, $10,000 every year and maybe not exceeding the standard deduction, you could give $30,000 in 1 year to get over the threshold and itemize, then maybe less the next 2 years.
Timing matters.
It can, to maximize the tax benefit. Another smart strategy, especially if you have appreciated stocks or mutual funds in a taxable account, is donating those securities directly to charity. You generally get a tax deduction for the fair market value of the gift, and you avoid paying capital gains tax on the appreciation. It's often much better than selling the stock and donating the cash.
Okay. Now, moonlighting. It seems like it's a growing trend for many professionals, not just doctors. Projections showing maybe up to 50% of the workforce freelancing soon. How does that impact a doctor's taxes if they pick up the extra shifts?
Right, it's increasingly common. First, a crucial caution. Always ensure moonlighting is permitted under your main employment contract or practice agreement. Don't risk your primary job.
Good point.
As for taxes, the key distinction is usually whether you're working as a 1099 independent contractor or as a W-2 employee for that extra work. If you're working as locum tenens, meaning you're filling in temporarily at a different hospital or clinic outside your primary employer, you're typically treated as a 1099 contractor.
Okay, 1099. What does that mean tax-wise?
It means you personally have to account for your income taxes. Usually this involves making quarterly estimated tax payments to the IRS and state. But the big advantage is you gain access to significant business tax deductions. Things like travel costs related to the moonlighting, maybe home office expenses if you qualify, continuing education, supplies. These are filed on Schedule C of your tax return. The TCJA, especially the QBI deduction we'll discuss, can be very favorable for 1099 income.
So 1099 offers more deductions. What about if you moonlight as a W-2 employee, maybe picking up extra shifts at your main hospital?
If you do all your moonlighting at the same facility or for the same employer group as your main job, it's typically just added to your regular W-2 wages. While you're still making extra money, which is great, it's taxed as usual through payroll withholding. You generally have far fewer direct deductions available against that income. The upside is you avoid the hassle of estimated taxes, and you often sidestep the need for separate malpractice or liability coverage if it's all under your main employer's umbrella. Fewer administrative headaches.
Okay, this brings us to a really major point our sources covered. Restructuring a medical practice itself, especially after these big tax law changes. Traditionally, many doctors preferred pass-through entities like S-Corp, but the TCJA shifted the landscape quite a bit.
It absolutely did. It created a real choice, maybe for the first time in decades, for many. The TCJA dramatically slashed the C corporation tax rate. It went from a tiered system topping out at 35% down to a flat 21%. And importantly, that cut is permanent under current law.
21% flat, that's low.
Very low historically. It also repealed the Corporate Alternative Minimum Tax, or AMT, which was a complex headache for many profitable C Corp. Now, pass-through entities, think S corporations, partnerships, LLCs, taxes partnerships, sole proprietorships. They didn't get a rate cut directly. Instead, they received a potentially significant new deduction, the 20% qualified business income or QBI deduction. This effectively reduced their top federal rate on that qualified income from 37% down to 29.6%.
So C-Corp got a permanent flat rate cut, while pass-throughs got a potentially big but temporary deduction.
That QBI deduction sunsets too, right? Like the estate tax exemption.
That's correct. The QBI deduction is also scheduled to expire at the end of 2025 unless Congress extends it. That temporary nature is a big factor in planning.
What are the other challenges or nuances with C-Corp? I always hear about double taxation.
That's the main historical drawback, yes.
Yeah.
Double taxation means the C-Corp pays tax on its profits at that 21% corporate rate. Then, if the corporation distributes those after-tax profits to shareholders, like the doctor owners, as dividends, the shareholders pay tax again on those dividends, typically at long-term capital gains rates, which can be up to 20% plus a 3.8% net investment income tax, so 23.8%.
Ouch. 21% plus potentially 23.8%. Potentially, yes. However, and this is key, those dividends are only taxed when they are paid out. So if the practice owners plan to reinvest a high percentage of the profits back into the business, buying new equipment, expanding, saving, rather than distributing everything as dividends, the C-Corp structure can actually lead to lower overall taxes during that accumulation phase because you're only paying the initial 21%.
Okay, so it depends on what you do with the profits.
Exactly. Another consideration is that C-Corp structures can sometimes make selling the practice more complicated or less tax efficient down the line compared to selling assets from a pass-through.
Are there any other tax benefits or maybe clever strategies associated with these different structures that doctors should know about?
Definitely. Tax advisors got creative after TCJA. For pass-throughs, especially for high-income doctors in fields initially limited for the QBI deduction, advisors found ways to potentially qualify. Things like maybe slicing the business, separating the clinical practice from, say, the building ownership. The building could be put in a separate entity, maybe structured like a real estate investment trust, and charge the practice rent. That rental income might qualify for QBI even if the medical service income doesn't or is limited.
Interesting loopholes, perhaps.
Or strategic structuring, let's say. C-Corp also offers some tax-free fringe benefits that are generally harder or impossible for pass-through owners to get tax-free for themselves. Things like health insurance premiums paid by the C-Corp, some educational assistance programs. These can be paid with pre-tax corporate dollars. And there's a special, albeit complex, benefit under Section 1202 for owners of certain qualified small business C-Corp. If held long enough, it allows them potentially to exclude most or even all of the capital gains when they eventually sell their stock.
Wow, okay. Lots to consider. This all sounds like it could build a pretty strong case for doctors trying to structure themselves as independent contractors, working through their own company, if their hospital or group allows it.
It can be a very, very compelling financial argument, yes. Our sources pointed out that historically, many physician groups were structured somewhat inefficiently from a tax perspective. Doctors classified as W-2 employees, especially with the highest individual income tax rates, faced the full brunt of those rates, plus FICA payroll taxes, with relatively limited business-related write-offs available to them personally.
Right.
In contrast, our sources suggested that doctors who are allowed to contract through their own S-Corp or C-Corp could potentially reduce their overall tax burden significantly. One source estimated a potential reduction of maybe $150,000 in taxes on an income between $500,000 and $600,000, comparing the contractor model using deductions and QBI versus being a straight W-2 employee.
That's a massive potential saving, $150,000.
Yeah.
But I imagine there have to be trade-offs for that kind of flexibility and tax benefit. It can't be all upside.
There certainly are trade-offs, and they're important to understand. As an independent contractor running your own company, you're responsible for paying your own estimated taxes throughout the year. No withholding to handle it for you.
Got to be disciplined about that.
Very. You're also responsible for the entire self-employment tax, which is currently 15.3% on the first chunk of earnings, around $168K for 2024. That covers both the employee and employer portions of Social Security and Medicare taxes.
So double the FICA, essentially.
Pretty much, yeah. Though you do get to deduct 1/2 of that self-employment tax as an adjustment to your income, which helps offset it somewhat. And perhaps most importantly, the IRS highly scrutinizes the classification of workers as employees versus independent contractors. You need to make sure the working relationship genuinely meets the legal tests for independent contractor status. Getting it wrong can lead to severe back taxes, interest, and penalties.
So you need good advice and need to do it right.
Absolutely critical. But for many physicians who can legitimately structure themselves this way, the substantial tax savings often make these trade-offs and complexities well worthwhile.
Understanding these tax nuances is just vital, isn't it? Not just for doctors, but really for anyone who is self-employed, considering freelancing, or wants to optimize their business structure for maximum financial efficiency. It's a complex landscape, but the opportunities for savings seem pretty significant.
Indeed. This knowledge is genuinely empowering for a wide range of individuals trying to navigate the tax code effectively.
And that really wraps up our deep dive into the complex, sometimes paradoxical financial world that doctors inhabit. We've navigated quite a bit, from the surprising realities of their debt burden and the crucial steps for asset protection to building robust retirement and estate plans, and then strategically leveraging tax laws for both their practice and their personal wealth.
Yeah, I think the key takeaway is really clear. Financial wellness for doctors isn't just a given simply because of their high income, not at all. It requires diligent planning, making smart choices consistently over time, and very often getting professional guidance to navigate what is truly a unique set of financial challenges and opportunities.
So what does this all mean for you listening in? Given the incredibly demanding nature of their profession and the significant impact doctors have on all of our well-being, what responsibility do we, maybe as a society, have to ensure that those who care for our physical health are themselves financially healthy? It's an interesting question. And maybe on a more personal note, if even these highly intelligent, high-income professionals can sometimes overlook fundamental financial principles due to lack of training or time, what steps can you take starting today to ensure your own financial health isn't being neglected, regardless of your income level? Something to think about.